Hi there. My name is Steve Schneeberger. I'm a realtor with Keller Williams Integrity Realty in Minneapolis, Minnesota. I am reaching out this morning because I've had a lot of clients ask me what I thought the market was doing in this somewhat crazy time that we're living in. And so I wanted to address that with data and facts. There's a lot of opinions swirling out there right now. There's one side of the aisle that's thinking that we're in a temporary situation here, and when we handle our health situation, we're back out of quarantine and business is back to normal. There'll be a large pent-up demand for real estate, and the market will shoot up again, kind of pick up where it's left off. And then there's another school of thought that thinks that we are heading into a recession. Whether or not this health scare would have happened or not, we were due for a recession. We've had a lot of economic growth over the last 10 years. It's been a long period of growth, and we're just due for a recession. So I wanted to just share some insights with you that are data-based, not opinion-based. And so for that, I wanted to just share this information. I'm going to share my screen here and just go over some things that I think are worth mentioning as we get into this new normal or new transition or whatever the case may be. So let's talk a little bit about how the current real estate market can help you buy a home in 2020. So just a little bit about me. I've been in business for 18 years, and I survived and thrived through the last recession of 2008, the Great Recession, they called it. And real estate was really kind of the leading cause of that recession. So I've come with a little bit of experience and a little bit of grit to say that wherever we are right now, it's going to change. It's just a matter of the time frame and what the change looks like. So that being said, let me just get into a little bit of the data points here. So why this shift is different than 2008. And there's a lot of things that are different today than there were in 2008. And let me just talk about some of them. So first of all, we're in the midst of this health crisis across the globe, and we all know that if we've got investments in the market, those investments have taken a big hit. I don't know where it is today. It's maybe 25 or 30% down from its high point back just a couple months ago. But just to put a little bit of perspective onto it, the last several outbreaks of different pandemics or epidemics, if you go back to 2003 in the SARS epidemic, that was affected trading for 38 days. The S&P had a 12.8% swing to the negative. The avian or the bird flu back in '04, 141 trading days it was affected. The market went down about 7%. MERS in 2011, 12 I should say, about 43 days of trading. Market went, the S&P 500 went down about 7.3. Ebola and then Zika, you saw the market decline about 13%. Let's talk about housing, because the stock market and housing do not always go up and down in the same way. So let's go back and cover the last 5 recessions that we've had. So 1980, we kind of were hit with a double whammy of recessions in 1980 and 1981. They were both caused mainly by the Federal Reserve raising interest rates to kind of try to slow down inflation. And I was back in high school during this period of time, so I was blissfully ignorant of what this all meant for people in the adult world as it relates to interest rates. But I've been told stories that home mortgage rates were 16, 18%. It was an insanely crazy market to buy real estate. But yet during that time in 1980, home prices nationwide appreciated over 6%. And in 1981, they appreciated 3.5%. Now in 1991, that little blip recession was caused by the savings and loan debacle. And we did actually have a little bit of a decline in home prices during that time, just about 2%. In 2001, we had our famous dot-com bubble. And when that burst, the stock market tanked and especially tech stocks and the dot-com stocks led the kind of the way in some massive stock market declines. But yet look at housing, it went up 6.6% in that period of time. Now 2008 was a little different because 2008, the crash, the stock market crash and the housing crash, they were both kind of related. The A lot of what happened in the housing market led to the overall financial collapse, and that was the mortgage-backed securities and the subprime loan lending. We had a lot of crazy loan products out there, a lot of really weird products, and people probably buying homes with no documentation, and people that bought homes that probably shouldn't have. And so as a result, we lost a whopping 19.7% in home values during that time. But let's look a little bit about mortgage credit availability over the course of since 2004, last 15 years or so. So you'll note that during the early to mid 2000s, 2005, 2006, in combination with this housing bubble, we had just an amazing availability to mortgage credit. And like I was saying, I think I bought my first home, and I was in real estate at the time, and it was a stated document loan that I just had to tell the loan officer how much money I thought I was going to make, and I got a mortgage. Crazy times. And so the availability of mortgages at that time were insanely high. You could get one if you could basically fog a mirror. But then look what happened as a result of that mortgage crash or the housing crash. We went down and we really tightened up the lending standards. And you can see from 2008 up till today, the mortgage availability has been pretty stable, meaning you have to qualify, and you have to provide documentation. You have to provide tax uh, statements and tax returns and bank statements and verifications of employment. So those lending standards have really been tight all through this time. Let's take a look at annual home price appreciation also during the period leading up to the Great Recession and to current day. So on the left-hand side, you'll see from 2000 to 2005, a couple of cases where on an annual basis there was a double-digit appreciation. 2005, 11.4, 2004, 12.5, and even in the years leading up to it, a good 8 to 9% appreciation. This is not a healthy appreciation. This cannot sustain itself. And so as a result, this was one of the other things that led to the Great Recession in housing in the mid 2000s. Now take a look conversely to the last 6 years. Housing prices and appreciation have gone up in a relatively healthy, stable manner. A stable appreciation rate is somewhere in the 3 to 5% range. And you can see that for most years leading up to 2020, we've been right within that range. Next, let's take a look at months inventory of homes for sale. Now, in 2007, we had a real strong buyer's market. In other words, 8.2 months of supply on the market in 2007 meant that if we as realtors stopped listing houses on a given day, it would take over 8 months to sell everything that was currently on the market. Strong buyer's market. Compare that to today. We've been in a strong seller's market for the last several years. And at 3.1 months supply, that is extremely low. What is balanced? Balanced supply is maybe 5 to 6 months of housing. So right now, the pendulum is still swung to the side of the seller, and there are a lot of buyers out there competing for fewer homes. And that is a really big difference between now and then. Also, another thing that was happening back in the early to mid 2000s where a lot of people were cashing out of their homes. We were seeing those 8 to 12% appreciations back in the early 2000s, and home equity was rising. People were using their home equity as an ATM machine. They were literally pulling cash out to buy boats and expensive cars and all kinds of crazy things that were really kind of ill-advised in retrospect. But if you look back at 2005, $263 billion of home equity was pulled from the market. '06, 321, and 2007, $240 billion in home equity lines were basically pulled off of the values of people's homes for a total of 824 billion in just a 3-year period. Now, it looks like we may have learned our lesson from back in the early 2000s, because look what's happened in the last 3 years. In 2017, $71 billion were pulled out in the form of home equity lines of credit or just second mortgages or various tools to be able to access cash in your equity. 2018, 87 billion, 2019, 74 billion, using an estimate from the fourth quarter of 2018, they came up with 74 billion for the end of 2019, for a total of 232 billion. So that's almost 2/3 to 3/4 less dollars that have been just kind of yanked out of people's home equity. So basically, people are living a little bit more conservatively today, and that means people have more home equity that they have in their house that they haven't tapped. So Danielle Hale, a chief economist with Realtor.com, was quoted as saying this recently: "If there's a Great Recession, it will be different than the Great Recession." Well, if there's a recession, I'm sorry, if there's a recession coming up, it'll be different than the Great Recession. Things unraveled pretty quickly, and then the recovery was pretty slow. I would expect this to be milder. There's no dysfunction in the banking system. We don't have many households who are over-leveraged with their mortgage payments and are potentially in trouble. And that just kind of restates what we just talked about looking at these previous tables. So let's focus our lenses and let's talk about the framework to view home buying in 2020. Right now, this has always been the case, but this is a staggering comparison between people who own their own homes versus renters. And this chart shows a difference in adults 65 plus who have net worth and total net worth, including home equity, homeowner versus renter. And so the blue bar there shows that the average homeowner, 65 plus, has a little over $319,000 in total net worth. Now that's home equity. You can see that portion of it is 143.5, but there's also, obviously other things, retirement plans and such. Now look at a renter, a 65 plus renter has a net worth of $6,700. Now, obviously, home equity plays a large portion of a person's net worth. It's not the whole story, but there's a big difference. And I think that part of owning versus renting is really a wealth building conversation. And so looking at that, the net worth of a homeowner is over 45 times greater than a renter's. What does that translate to? So if we are to look at, and just take some estimates over the next 6 years. Now I realize this graph might be a little dangerous because we're predicting into the future. I said I wasn't going to do that, but this is something that comes from a home expectation price survey taken Q4 of 2019. Let's just go with it. It may be flat, or it may rise at this level. But you can see in today's dollars, a $250,000 house could be worth almost $300,000 in 6 years. Now that's a $47,500 increase in equity. Now go back to those slides that we talked about earlier, where during a recession, remember, it's not necessarily the case that home prices are going to go down if the stock market goes into a recession and the economy goes into recession. It's not necessarily correlating to each other that we have a decrease in home valuation. So just keep that in the back of your mind here. So really what this is it's a long-term wealth conversation, not an expense conversation. It's not necessarily about what you're paying for your mortgage, about what it costs to run your home. As you can see from the last couple slides here, people who own homes tend to build more net worth over time than people who don't own their homes. So let's finish up with talking about the advantages to home buyers in 2020. First of all, we have interest rates. Now, interest rates have been bouncing around a little bit, but look at the chart here. You can see that they're still at historic lows. Back in the 80s, the early 80s, where we had that spike where we were up to look like 14, 16% interest rates, 18% on a 30-year fixed mortgage. That is completely the opposite of where we are today. We're down in the 3 to 4%. Now, I just make a side note here because at this very moment in time, the lenders are just completely flooded with mainly with refinances. And you might find that interest rates are higher than you would expect them to be. Part of the reason is of the uncertainty going on in today's environment with the health situation. But another reason is the lenders are so backlogged with mortgage applications that they're just raising the rates a little bit just because they can. It takes, they've got to hire more people to process all these refis and purchases. And it just is, it's kind of supply and demand. When demand is high, you can charge a little bit more. And that's kind of what's happening a little bit right now with interest rates. So double check with your loan officer exactly what the rates are if you're looking at refinancing. Here's another slide, 30-year fixed rate mortgage. And this is just back from June 2018. We've been in a really strong real estate market for the last 3 to 4 years. And look at, they were 4.5% up to 4.75% in the end of 2018. And we saw a decrease again in 2019. And now here we are in March of 2020, going into April, and we're pretty much at close to historic lows again on a 30-year fixed rate. So how does that relate to mortgage payments? How does the cost of money, how does interest rates, how does that relate to mortgage payments? And let's break it down by decades, just to kind of compare, where we've been and where we might be going. So the stats that you see here are based on a mortgage of $250,000. Back in the 1970s, the average interest rate on a $250,000 mortgage, 8.86%, which would translate to a monthly payment of $1,986. In the 80s, we all know that interest rates were higher. Of course, higher earlier in the decade than later in the decade, but on the average in the 80s, it was 12.7% interest rate, which would have amounted to a $2,700 mortgage payment, monthly mortgage payment. In the 90s, we were a little over 8% interest, 1855. And in the 2000s, at 6.29%, our mortgage payments were about 1550, just under. Now today, with mortgage rates being at 3.66%, as I speak, they could go up, but that same $250,000 mortgage is $1,145. So even if we project rates to go up in the next 12 months, they're certainly not going to go up to 6%. At least we don't see that happening. They haven't been that way for many, many years. So look at the buying power and look at the monthly payments that you can achieve by being able to lock in at today's low rates. And speaking of buying power, here's an interesting slide to compare. So back in 2006, the percent of median income somebody needed to purchase a median priced home, so kind of on the same scale, apples to apples, was 25.4% of their income. So 25% of their income went to housing cost. Today, with factoring in lower interest rates, factoring that people's wages have gone up a bit, the median, the buying power is at 15.5% of a person's median income. So let's break that down a little bit. So home prices in the last year have risen. On average, 5.7% has been the change from last year to this. So obviously that would negatively impact a person's buying power in the range of about 21,300. Mortgage rates have actually gone down almost 1 full point, 0.85%. So when you look at it again, that increases your buying power. And in this case, it'd be about $40,000. And then wages have gone up 1.5% in the last year, and that gives you another $5,600 in buying power. So comparing year over year, the total impact on your purchasing power, you are able to afford $24,000 worth of home more than you were able to afford a year ago. So let's take a look at the impact of monthly housing prices and on the inventory of home prices. So like I'd mentioned earlier, a balanced market here, they say it's 6 to 7 months neutral market. I kind of like to go with the 5 to 6 months. It varies by who you talk to. But a seller's market is anything less than 6 months. And as we talked about earlier, it's been about 3 months supply currently right now. Home prices will appreciate in that environment because there are more buyers chasing fewer homes for sale. In the neutral market, home prices will just kind of wobble around. They maybe not go up, they maybe won't go down, they might just appreciate with inflation. Now, in a buyer's market, now that was where we were back in the Great Recession in the mid 2000s, where really everybody that wanted to sell a house decided to sit on the sidelines. And we had the glut of bank foreclosed properties and short sales that hit the market. And there were a lot of listings to choose from and fewer buyers because they were scared as what was going to happen. So we kind of learned our lesson from back then that the market eventually turns around. But if you are to look at a buyer's market with 7 months or more of supply, that is going to cause home prices to depreciate. So advantage number three, we have the buyer pools out there. So if you're a seller right now, we still have historic lows in inventory. Home building has not been able to keep up with demand. The wage rises have been solid. And even if we have a little bump in the road here with employment, we're hopeful that things will be a short-term versus long-term in terms of people out of work. There's still a lot of people that have secure jobs. A lot of us are working from home. A lot of us are internet-based. And unfortunately, it's affecting a fair share of people, but it's also not affecting quite a few people. So we'll be hopeful that things will turn around soon. But what are your next steps? So given all this information, I think there's a case to be made that we shouldn't just sit on the sidelines with regards to real estate. People who need to sell their homes are still going to find that they're going to get a decent price. People who want to buy homes still are going to get incredibly low interest rates. So my advice is let's think logically. Let's not pay attention to the swings of the daily news. Let's look at facts and data versus listening to people's opinions and panicking. So I'd love to have a conversation about you with your real estate goals and whether you had plans to do something this year and now you're thinking twice about it. Let's talk. We might be able to figure out that there may be still a solution for you that could be advantageous. And for those of you who are still a few years away and maybe not thinking about things right now, but just have general questions about the market, by all means, reach out, call or text. I'd love to have discussions with you. I'm a student of the market. I'm learning things daily. Markets and things are changing daily. So let's stay in touch. But for now, I'm going to sign off. And I really appreciate you sticking with me. And we wish you well. And let's all stay healthy. All right. Enjoy the day. Bye-bye.